Okay, so I want to shift gears, talk about three of the companies that we own in Tarpon currently. The first, as you might guess from here, if you hadn't noticed in your account already, is Amazon. This is actually Amazon.com's first website. So a bit of internet nostalgia, I suppose, but how far they've come. Amazon is absolutely one of my favorite businesses. It's fairly easy to really get lost in discussions about them. They're no longer just the bookstore that many of us kind of grew up knowing. Amazon is really a platform of platforms in many ways. You kind of get a quick sense of a lot of the different irons they have in the fire, if you will. There's a great recent article on Forbes about Amazon's supply. Basically, they're entering the wholesale business, which in and of itself could be huge. There is also a great book that came out late last year called The Everything Store, by Brad Stone. Really great snapshot, or really detailed account, I should say, of Amazon and Jeff Bezos, the CEO in particular. Um, Amazon went public about 20 years ago. The week we held the annual meeting, at a split adjusted price, it was something like $1.50 per share. And it was up 200-fold since then. Amazon went from zero in sales to 74 billion last year. So, I suppose I won't be accused of being early with Amazon. Amazon kind of came onto my radar screen a few months ago. This is not a new position for us. Stock price fell about 28% year to date for at least through I guess April, when it first kind of really fell on my radar screen, and it just became of immediate interest to me. It is an exceptionally profitable business. It's just that those profits are easily obscured by the reinvestment the company's doing into all those platforms. Through some slides up here, these are all, I should cite them appropriately, from Business Insider. Just gives you a good flavor for how sales are doing for them. They got started with media sales. Amazon, in and of itself, is now 14% of all e-commerce. It wasn't that long ago that e-commerce as a percentage of total retail sales in the U.S. was about 2%. Now we're up to that 6.5% level, maybe 7%. And so you can kind of look at that and you can think of how many things that really still can be sold on the internet that aren't being right now, and the costs that really are removed from the system by doing that. And specifically, getting rid of the storefront, reducing the number of employees you need, everything that a traditional retailer has to pay for. All the advantages that were hyped and overblown to such an extent in that 99 2000 time frame. Really, the reality is that many of them are still advantages, and they still are true. Only the hype is become a little bit more of reality, I suppose, in the intervening 13, 14 years. One of the other statistics I think is interesting is that today, still, there's 2/3 of the people in the world do not have an internet connection at all, let alone shop online. So, the point is there's still sort of a huge runway for Amazon. Another couple slides, I thought, just to give you a sense of sort of the scale of Amazon, and frankly how much of a juggernaut the company really is. So again, I think if there's an investment thesis that's easy to articulate, it would be essentially this. Amazon is an exceptionally profitable business, but it's not immediately obvious. Its reinvestment specifically into all those other platforms you saw a few slides ago really obscures that fact from view. And more specifically, if you attempt to normalize the company's operating margins, i.e. if you're trying to distinguish between what the business needs today and what is being reinvested in Amazon in the growth of other initiatives, and if you really just get at the underlying profitability of the company, and again, more specifically, what they're earning internally via returns on invested capital specifically, those numbers are really unheard of. Again, it's a little bit of an approximation, it's the best you can do, but you can still take a good hack at it. And those returns on invested capital, it doesn't take too many assumptions at all to get to the range of 60-70% a year. So in other words, just back of the envelope, every dollar that's added to the capital base of Amazon is creating up to $7 of value at the company. So it really is an amazing business. Again, it's really just the result of finally drilling down long enough. The stock dropped 28%. That was sort of my cue, I guess, that all right, time to start really drilling down and see if we can get arms around the company, and felt like we did. And with any other company, using any sort of estimated 5-year growth rate of call it 17-18% a year as an input into any sort of discounted cash flow model would really cause me to roll my eyes with skepticism, I suppose. But in Amazon's case, it sincerely does appear warranted, and especially when you consider that their gross margins should continue to expand. That's both with scale. There's a lot of scale built up in retailers in general, let alone online ones. And as they roll out higher margin services and in general, just kind of tweak the dial on their operating leverage. So, long story short, it appears pretty likely that when we started buying shares of Amazon earlier this year, that shares seemed undervalued by about 40%. Again, that was after shares fell off a cliff for really unclear reasons, other than a lot of tech just seemed to get walloped earlier in the year, and shares dropped almost 30%. Really on no news other than sort of macro angst, which is why it got interesting to begin with. This is a controversial pick in the value investing community. Most value investors, myself included, like to see cash, prefer to see cash, and lots of it right now. So it's a little bit outside the mold. And then in Amazon, we are investing in a business that is consciously foregoing profits in the short term, really to build a bigger and bigger moat in the Buffett sense of the word. It is not conventionally cheap. Somebody made a comment online, an analyst I read online, that I thought was actually pretty good. If you look at the financials first to then inform yourself about the business, you're going to come at your opinion of Amazon a different way than if you do vice versa. And to go back to that slide in which I talk about the process, I mean, there is a reason that the number one step in the process is all about the business, and making sure you're kind of viewing it through the right lens at first. Bezos, the former Time Person of the Year here, back in the night, he still owns 18% of the company. He's only 50. This is the Amazon flywheel, which, if you read the book, The Everything Store, it does a great summary of this as well. This is the magic of Amazon. It basically centers on scale advantages. As the company gets bigger, they get better prices out of their suppliers. They can then pass those savings on to the customers. So even more people shop there, which creates more sales, which lowers costs further. The whole sort of virtuous circle, if you will. That is the Amazon flywheel, and that is, what Bezos and his sort of inner circle determined fairly early on was going to drive their success, and sure enough, it has. That's also one of his better quotes. I really enjoy reading Bezos's letters to shareholders as well. They're not quite Buffett-esque, but again, he's an operator, and he is trying to be somewhat stealthy about a lot of what he's doing. But they are very good, and I encourage you to read them if you can. They're on the Amazon site. And to summarize, the bet here is that Amazon will continue to compound at very high rates for a long time. So that is one of our newest positions. It's also one of our largest positions. And hopefully that gives you some sense for why that is. Like Amazon, when it comes to fiat, it's also easy to get lost obsessing about their different brands. Fiat has really come a long way from the fiat means fix it again Tony of 20 years ago that some of you may remember. Fiat is one of the largest positions in Tarpon right now. By way of sort of brief intro, Fiat is an Italian automaker. It owns the Fiat brand of cars as well as Ferrari, which you might not have known, Maserati, Alfa Romeo, and now all of Chrysler as well, and those sub-brands like Jeep, Dodge, the great new Ram truck. So it's the ownership of Chrysler, I think, that is probably most appealing to me, at least that sort of caught my attention at first when I started drilling down on Fiat a while back. To be clear, Fiat is a highly leveraged turnaround situation in a cyclical, capital-intensive, really fiercely competitive global industry. So it's not for the weak of heart, and there certainly is some hair on it, as they say. But that's also why it's cheap. One of the sort of underlying themes of the Amazon investment really speaks to management and the quality of that management team and the vision of Jeff Bezos. Management of Fiat as well is similarly important. Sergio Marchionne, an iconoclast, I suppose, in the industry. He's a guy who he'll quote Nietzsche and Tolstoy and letters from school kids in Detroit when he's talking to the public or the street analyst. He has proven himself as one heck of an operator, though. Marchionne led the buyout by Fiat of Chrysler when it was bankrupt back in 2009. Fiat basically got a 20% stake at the time. Sergio Marchionne, as part of that, also became CEO of Chrysler. 2 years later, he bought the interest in Chrysler owned by Canada and the U.S. Treasury, which then got Fiat to about 54% ownership of Chrysler, and more importantly, control, because they had majority say. Then fast forward a little bit. The first of this year, Fiat agreed to pay about $1.75 billion, I remember, to United Auto Workers for really the rest of Chrysler. So that means essentially that Fiat will have paid a total of $3.7 billion to acquire Chrysler, which, by way of contrast, is obviously significantly less than the $36 billion that Daimler paid for the company in 1998, or, by way of contrast again, the $7.4 billion that big private equity firm Cerberus Capital Management paid to acquire an 80% stake in Chrysler in 2007. So a very savvy operator, a very savvy deal maker, and as you might expect, both those things are really core to the value thesis. You can also tell there's just some good sort of internal indicators that Marchionne's got them on the right track. Maserati today is making more in a single quarter than it used to make in an entire year. The Dodge Ram 1500 has been Motor Trend Truck of the Year at least twice, I believe. Jeep has posted 2 record years. The company expects a 3rd record year. Currently, they're on track to pass the 1 million vehicle mark, and more recently, the new Chrysler 200, I believe, had something like 17,000 orders in its first 2 days. So they are dialing in and kind of really have again a runway in front of them that's very attractive from the valuation standpoint. Here's what the market is missing, though. Right now, the market cap of Fiat is just under about $12 billion. So again, that's the value the stock market has put on shares. I think that's ridiculously low, and here's why. For one, the value of Ferrari alone is probably close to $7 billion. Just, that's a bogey based on my own estimates as well as that of a number of auto industry analysts. And then you got to factor in, that savvy bit of deal making that allowed Fiat to really buy all of Chrysler for essentially, a ridiculously low price, particularly compared to a couple of historical transactions. So, the buyout of Chrysler by Fiat was really a game changer. It was recently finalized earlier this year. Among a lot of other positive, it's going to help the company fill up capacity at all of its money-losing Fiat plants. Marchionne's got plans, for instance, to start putting Ferrari engines in Alfa Romeo. So kind of a lot of different levers they can pull internal to the business. Here, though, is sort of one major takeaway, and I think which probably summarizes a lot of the different moving parts. Number one, it's going to take some time. Again, that's probably also why it's cheap in a world that just can't seem to wait longer than 30 seconds for something to develop. If CEO Sergio Marchionne, if he can get sales at Fiat up 5% and NPMs or net profit margins to 2%, then Fiat is trading at a 2016 price to earnings multiple of just less than 5. And again, the average PE ratio for an otherwise average company is 15. So clearly, again, very back of the envelope, but it's probably the easiest way to highlight it. Clearly, things seem demonstrably cheap. Now, keep in mind that Marchionne's plan is to get those net profit margins to 4%. So, it's just there's a lot of levers there. There's clearly a lot of room for the valuation to expand and really become what it's worth. It's, again, going to take some time, but that is that's the deal. It takes a little work to sort of get at those numbers, but there's a lot to like to Fiat once you kind of start peeling the onion and once you can get past some of the complexity of all the subsidiaries that are owned, and really kind of dial in on what the intrinsic value should be.